Good morning, everybody. Welcome to today's webinar. It is dreary outside, it is rainy outside, it is cloudy outside, it is cold outside, but it is the season of giving. We are in the holiday season, so we wanted to make this as timely as possible, and we're so happy that we have such good attendance today. Um, Hopefully everybody can see my screen, see me, and hear my voice. If you can give like a thumbs up or something, if all of that is visible and auditory is coming through clear, I would appreciate it. Good, thank you. So as usual with these webinars, what we're going to do is we will record the webinar so that it's available to you, but I also ask that if you have a question at the bottom of your screen, there's going to be a Q&A box. You can just click in that Q&A box, whether you want to be anonymous or not, ask your question, submit, and it will come through to us and we'll address that at the end. These webinars historically have taken about an hour, but they don't have to. So if it's less, but you ask more questions and we go for 50 minutes, that's totally fine. We don't want to keep you here unnecessarily. So let's go ahead and jump in. It's the title of this webinar is Financial Giving This Holiday Season, How to Share Wisely and Tax Efficiently. And of course, this particular webinar was mostly requested by the children and grandchildren from our client base. So as you can imagine, it's a particular interest to them how money can be given. I of course joke, but I do think that this is just one of those things that we're finding with our clients. More than want to give to charities, help kids out when they need it, help out grandkids, and hopefully this gives you some really good information to do that. One of the things we do need to mention is we're going to get into some tax planning, estate planning conversations, and you have to remember this is for general information purposes. This is why we always recommend you have an estate attorney and you have a CPA so that you can make sure what we talk about here when you go to put it into action is checked by one of those authorities. So what we're going to talk about, we're going to start with, taxes in general, what a donor advised fund is, what a qualified charitable contribution is, talk about different planning opportunities. We're going to go through some case studies, giving money to loved ones. How can you do it? What are the rules? What are the dollar amounts? And then we're going to go into questions. So the whole point of this is to spur you to ask questions. We're also going to have some polls or questions inserted into the webinar so that this can be a little bit more interactive for you. So you're going to see on the next slide kind of where we want you to go on your phone or on your computer so that you can participate in these questions. This is our team. So if you could go, and this will be again, when we ask the questions, you'll see this out there. But if you want to kind of be ready, if you go to pe.app/4J, it'll pull up the questions you're ultimately going to see in here. And we want you to answer as best as possible. And then we'll review the answers together. So let's start with kind of zooming out and thinking big picture about your taxes and your tax return. So remember, you have your income that comes in, and then there's certain deductions you get. And there's basically two paths you can go with the deductions. One is to go the standard tax deduction route. The other is to itemize your deductions. If you itemize your deductions, the only time you're going to use those itemized deductions is if they exceed your standard tax deduction amount. And that standard tax deduction amount for most people exceeds those itemized deductions, okay, because they've increased the standard deduction significantly. So you can look at which of these applies to you, but I'm just good with the married filing jointly for simplicity purposes. So the base standard deduction for if you're married filing jointly is $31,500 for this year. If you and your spouse are over 65, it's another $1,600 for each of you. So if both spouses are over 65 and they're married filing jointly, there is a standard tax deduction of $34,700. The only time you're going to itemize and do schedule annual return is if your itemized deductions exceed that $34,700. Now, we have a note here below because this is brand new as part of the OBBA bill. which is called the senior bonus. And it's only around from 25 through 28. And what it's designed to do is to give you the potential to have an additional, for a married couple, an additional $12,000 of standard deduction on top of the $34,700. However, that's only available if you're married, if your adjusted gross income is $150,000 or less. Once you get over that amount, it starts to reduce pro rata. At $250,000, you're back down to just the $34,700. But the reason I bring this up is if you're over 65 and your income, because you're retired, is below that $150,000, your standard deduction could be almost, like, not quite, like $47,000, $48,000, right? Which is very, very significant. And for most people, that's going to exceed their itemized deductions. Okay, so I think just understanding big picture, you either take the standard or you itemize. You don't do both, right? If the itemization is higher, and we're going to talk about how you can make that amount higher with the DAF, then you take that. Remember, if your itemized deductions fall dramatically, you always can get the standard deduction, right? So even in a worst case, your itemized deductions are $10,000, well, you're still going to get the standard deduction of $34,700 for this year, as an example. Okay. In addition, this is all on the itemized side of the equation, right? There's a new SALT cap under this bill. And in 2025, that SALT cap went from what used to be $10,000, where you're capped at 10, to now 40. Now, what goes into that? It's your state and local taxes. So it's your property taxes and your state income taxes are the two big ones. So if you live in the Northern Virginia area, and you think about, okay, well, my property taxes, they're probably going to be pushing 10,000, maybe higher. Once you factor in your state income taxes, they're very likely to be higher. So that part of your itemized, that's one of your itemized deductions, is the SALT. That could easily be $12,000, $13,000, $15,000, $20,000. So now it used to be capped at 10, it goes all the way up to 40. Right? This is going to last through 2029, and then it will revert back to the $10,000 cap. Now, there is a caveat for very high income earners. If your modified adjusted gross income is over $500,000, if you're married, then that cap goes down precipitously. Like, basically, once you're at like 550, the cap goes from 40K to 10K. So the whole point is it's designed to give tax deduction to people who make less than really that $500,000 level. Once you're above that, they're like, yeah, you're kind of on your own. You can pay the taxes. So the reason this is significant is when we're looking at, do we take the standard to itemize? Well, this portion of your itemized deductions could be materially higher than in previous years because you're no longer capped at that 10, right? Maybe it's 20 here, and then you have a little bit for medical expenses, and then charity, right? All of those are the different parts of itemized deductions. That all goes into say, okay, is this total amount, if I add all this up, higher than the standard deduction? And you take the higher of the two. So this is the first thing we're going to talk about as it relates to giving, but we had to set that context first for how taxes work, or this wouldn't make as much sense. So many of you probably have heard of a donor advised fund. Some of you may not, but that's why you're here. But a donor advised fund, we call it DAF for short. It's a charitable giving vehicle that allows you, in its simplest form, it allows you to make a contribution to a donor advised fund today, and you get a tax deduction for that year that you make that contribution. And then you can grant the money from the DAF to the end charity of your choosing, okay, on the timeline that you wish. So there's a separation between when you get the tax deduction and when that money is ultimately granted to charities of your choosing over time. And that's what makes this powerful, right? And we're going to go through examples, but I know, okay, if I give $5,000 a year to charity, I could say I'm going to do 5 or 10 years worth of that today. I have a particularly high income year this year. I'll get the full tax deduction for that amount. And then I'm pre-funded to give to the charity over the next 5-10 years with the money that's in the DAF. So what are the benefits, right? One is, to the extent you're giving to charities now, you'll be able to support those same charities, right? You get a same-year tax deduction for the money you're putting in today. We're going to talk more about this, but to the extent you're giving a security like a stock that has embedded capital gains, you don't pay capital gains tax on that money. Once it's sold in the DAF, none of that is taxable. And you have flexibility. You can put cash in if you wanted, but you can donate securities, stocks, bonds, mutual funds, and there's other things too, but those are by far and away the most common. And the additional benefit is that money that goes into the DAF can grow. It actually can be invested in the DAF at a risk tolerance of your choosing, and that growth, right, occurs tax deferred. As long as it goes to the charity, it comes out tax free. So a lot of benefits beyond just the income tax deduction that we're looking at here with this type of a vehicle. So how much of a deduction will I get? So here's some important things to keep in mind. If you donate cash into the donor advised fund, you are eligible for an income tax deduction up to 60% of your adjusted gross income. So let's just keep numbers simple. Let's say for some reason one year you have an income of $100,000, but you are very charitably inclined and you have a large net worth, and you say, I'm going to give all 100,000 to the donor advised fund. I'm going to move my cash to my DAF. And in your head, you're thinking, okay, that'll wipe out my income for the year. Well, they don't allow that, right? So they limit you to 60%. So if your AGI was 100,000 and you gave 100,000, you could only deduct 60,000 for that year. So you probably don't want to give more than what you're eligible to deduct in that year. Now, there are some carry forwards that are allowed, but I'm just giving you kind of the black and white simple version here. Now, let's say you have you have a sizable position in an appreciated stock, and you don't want to sell it because you don't want to incur this really big capital gain. You can donate some or all of that stock to the donor advised fund and avoid the capital gains tax. You will also, right, get an income tax deduction on the fair market value of the stock. But again, the amount of the deduction is limited to 30% of your adjusted gross income. So if we go with the same example, $100,000 AGI, you say, oh, I have this huge position in XYZ stock, I'm going to gift the whole thing. You'll be able to gift it, but you won't be able to deduct more than $30,000, okay, for that year, because it's 30% of your AGI. You're capped at that. So just, again, not many people fall into this, but it is important to be aware of. So what can I donate? What I'll say here is these are kind of all the different things that are possible. The only ones we've ever dealt with and would feel comfortable dealing with and answering questions on are kind of publicly traded securities, mutual funds, stocks, bonds, cash. Yes, there are ability to do more exotic contributions to these things, but it's much more complex and much more involved. And we would definitely need to get, specialists involved if you wanted to do something like that. Now, this particular donor advised fund examples we're talking about it's the Fidelity Donor Advised Fund. Fidelity Charitable, I think, is the largest public charity in the world. Schwab has one. I mean, a lot of the big institutions do. There's no minimum contribution. There's no minimum account balance that's required. There is a minimum grant amount of $50 to send out just to make sure it's above some de minimis amount. And what Fidelity charges is the greater of 0.6% on what's in there, or $100. The money can also be invested, and it's similar to a 401k, and there's kind of pre-selected investment options to choose from, ranging from super conservative to, all stock aggressive growth. But again, if your time horizon is long enough, then having some portion of the DAF money in stocks can make sense, because that can appreciate, and that appreciation can go to the charity, which saves you from having to potentially make more contributions in the future. But it's also just money that's growing tax-free, right? And ultimately going to go to the charity for its benefit. Okay, so here's our first question. What happens once assets are contributed to a donor advised fund? So if you can go ahead and go to the pe.app/4J or scan, or scan this QR code, this question will show up. And then if you can go in and select A, B, C, or D. So what happens once assets are contributed to the DAF? The donor can request assets back anytime. The assets must be granted to the charity out within the same year. The donor must choose a single charity for all grants, or the assets become irrevocable. Their irrevocable charitable gifts owned by the sponsoring organization. So I'll give you guys a minute to try to figure out how to get into p.app/4j and answer, or scan the QR code. So I'll just take a second here to do that. It's good. We have a variety of answers while we're here. So here's the so there's an equal amount who answered. The donor can request the assets back at any time. Now it's moving more towards D. So the reality is the whole reason you get the tax deduction in the year you make the contribution, even though you're not granting all charity, is because it's an irrevocable gift, right? That's why the IRS is letting you do this. So that money cannot come back to you, right? It is an irrevocable gift. But the assets do not need to all go out to the charity in the same year, and it doesn't need to go to a single charity, right? You could put in $50,000, and then next year give $7,000 to one charity. The following year give $15,000 to 3 charities. You have total flexibility. But the one thing that you must know is once you give to the DAF, it can't come back to you. Can't come back to you as the donor. All right. Thank you for answering that. So what are just a quick summary of the benefits of the DAF? Potentially you get that income tax deduction, right? If you're itemizing, you're eliminating the potential capital gains tax when you donate, appreciated securities, and there's potential tax-free growth of the funds in the account if the investments go up over time. So it's pretty powerful strategy to the extent you're charitably inclined doing the donor advised fund path. So what type of asset is most commonly contributed to a donor advised fund for tax efficiency? So let's think about this, right? So now it's okay. Yeah, we're going to get the tax deduction, but what specifically would I want to contribute if I'm trying to maximize tax efficiency? Would I want to give cash? Would I want to give from my money market, from a bond fund, or from long-term appreciated stocks? Looks like the answers are coming in. You guys are doing a good job. This one we're right on the money for, right? So looks like nobody got this one wrong. And the answer is in fact B. And why is it B? Well, because if I have a long-term appreciated stock, that's exactly the type of thing from a tax standpoint I would want to donate, because I'm not going to pay any capital gain. No one's going to pay any capital gains tax. Not me, not the charity. And you get the deduction based on the fair market value of the stock. So yeah, that's definitely the ideal way to do it, all else equal. So the big beautiful bill, other changes you need to be aware of. This gets a little bit nuanced, but it is important. Before, when you gave to a charity, the whole thing was eligible for deduction. But now they're putting a 0.5% floor. So for an example, $100,000 adjusted gross income, the first $500 you give to a charity is excluded, right? So if you gave $1,000 in that example, you would only be able to include $500 of it as a charitable deduction because of this new rule. Okay, and that includes if it's going to a donor advised fund. The other thing, this won't apply to many people, but just something to know: if you're in the top tax bracket, what your deductions will be deducted at will be effectively at the 35% rate, even though you're in the 37% rate. Okay, so it's just a way to limit the deductions on high income earners. And then third, if you do not itemize, so you're getting a standard deduction and you just want to give cash to a charity, you can get an additional above the line deduction. So if you get that 34.7 standard deduction, and you gave $2,000 to a charity, you would get for married filing jointly, you would get an additional $2,000 deduction before your adjusted gross income even. It's above the line. So you get the 2,000 deduction and then the standard deduction would be on top of that. But if you itemize, you don't get this. Okay? Again, if you have questions, if they're coming up, put them in the Q&A and we'll make sure we address them. You can also put them in the chat if that's easier for you. Okay? So what are the planning opportunities for 2025? Because this rule starts in 2026, right? And you're thinking of doing a donor advised, now would be a good year to do it to lock in the maximum deduction you can get. And remember, if you're doing those donor advised fund, right, you also get the higher SALT cap. So when you look at this, like, okay, my SALT deduction will now be this because it's not capped at 10. My mortgage interest adds this. How much would I need to do to a DAF to exceed the standard deduction I would otherwise get? And if it's still a comfortable amount that you think, oh, I'm going to definitely contribute that to charity over the next 3, 5, 7 years, even 10 years, then do it. Like, this is the year to do it. And you'll get a higher deduction. And especially, again, if your income is higher this year for whatever reason and will be lower in future years, you want to strike when the iron's hot. So it's a unique window, especially for high income earners, because starting in 2026, you're not going to get that max marginal rate deduction. You're going to have that 0.5% floor. That's for everyone. So strategic use this year, this is why we've been talking about this during our reviews with you all year, makes a lot of sense. So let's go through a case study. I'm the kind of person where it's like, okay, this is great in the abstract, but how does this actually work in an example? So we'll took a hypothetical couple, the Thompsons, John and Sarah. They're 52. They have an adjusted gross income of roughly $200,000, and historically have given about $5,000 per year to charities. Their income is higher than it used to be, and they do expect a large bonus this year. And they hold stock from a previous employer that is highly appreciated, but doesn't align any longer with their investment goals. So what they're looking to do is still give to their charities, try to maximize their tax deduction, simplify how they're giving to the charities, and they want to be able to give on an ongoing basis, even in years when their taxable income might be lower, right? So simply donating cash each year, which is what they have been doing, really is not going to fulfill these goals, right? It's not going to fully maximize their tax opportunities. So one strategy, right, is establish a donor advised fund. So you establish a donor advised fund. Once the fund is established, you can then say, I want to contribute 50,000 of XYZ stock, which, by the way, we only pay $20,000 for. So there's a $30,000 embedded capital gain. And here are the benefits they would receive. One is they would get a deduction of the full fair market value of the stock, or $50,000. Two, there's no tax on the $30,000 of embedded gains because they donate it to a charity. And then three, right, they can front load multiple years of giving into one single high income year. So if they're giving $5,000, even if they put it in the DAF and it earns nothing, they can give $5,000 to their charities for the next 10 years. But even better, if that money is invested, or some of it is invested, some may stay in a money market, that some of this money, the 50, could grow to 70 or 80 or even 100 over 10 years. And now not only are they giving the 5K, but they probably can do a lot more, or select a different charity, a new charity, to do the excess, right? They can do it any way they want. But those are the three big things. And again, the grants, there's the difference, right? We talked about this. There's what you put in initially, and then there's the grants that occur to the charities over time, right? So if they still want to do that same cadence, they can do it. It's just from the DAF versus from their checking account, right? So it simplifies things. The grants can be really on any timeline. So how this works is, if you wanted to do this with 4J, we would set up you call us, I want to set up a donor advised fund, kind of like any account, it just gets set up. So it's an open account, nothing's in it. And then you say, okay, here's what I want to fund it with. Those securities get transferred in. Once they're transferred in, the DAF will sell it. And then we basically select one or more investment options based on your investment objective and risk tolerance. And then you would basically tell us, hey, I want to talk once a year and tell you, here's the charity or charities I want to give to, and here's how much. Or there's actually a way to set up scheduled grants, right? Scheduled grants where it goes to the same charity and you can do that on a regimented basis automatically from the account. We generally don't do it that way very often. Most clients want to kind of call us at different points of the year and just say, hey, I'm ready to grant this amount to this charity, and then it's handled that way. So just to give you kind of the understanding of how this is set up and how it works logistically. Okay, so that was a lot on DAFs, and we think they can be a great vehicle for people who are charitably inclined. There is another way to give to charity that is also very effective, and that's called a Qualified Charitable Distribution. So totally different than a DAF, and we're going to compare the two. But a QCD, which is Qualified Charitable Distribution for short, is a direct transfer from your IRA to a qualified public charity. It never hits your account. It goes directly from the IRA to the charity. And why people do this is that any money, as you know, that comes out of an IRA is generally taxed as ordinary income, all of it. And so when it goes directly to the IRA, directly to the charity from your IRA, it's excluded from your gross income, right? Which can lower your taxable income. And if your RMD, so let's say your RMD is $50,000, if you give $10,000 to a qualified charity, that helps to satisfy your RMD. So you would only need to take out $40,000. We have some clients who don't need anything from their IRA, so they give the entire RMD amount directly to a charity, and none of it's taxable. But a lot of people don't know this. And you don't need to itemize in order to do a QCD. Anybody can do a QCD, whether it's you take standard or itemized. There is a maximum amount you can do, which is $108,000 for this year. And once you get to 70.5, you can do a qualified charitable distribution, even if you're not RMD age yet, right? Because a lot of people aren't going to reach RMD age until 73 or 75. But you could actually start this at 7.5. Why would you do that? Well, if you're giving to charity anyway, this is a really, really great way to do it, right? Because if you say you're looking the DAF route, but even with the DAF, you're not going to itemize, boom, the QCD makes a ton of sense. And we have a ton of clients who do it because it's like, hey, I need some of this, but not all of it. I'm already giving to charity. This is the easiest, most tax efficient way to do it. And we make the point here, right? It helps people who don't itemize and otherwise wouldn't get credit for a deduction. A lot of people, I think, just in the habit of giving money from their checking account, their bank accounts, because it's what they've always done, and they're not aware of all these different tools and mechanisms and strategies that they can take advantage of. So the DAF is a big one, and then the QCD is another really big one. So another interactive poll. What is the primary benefit of a QCD? It allows for dollar tax deduction on itemized returns. It can reduce your adjusted gross income, potentially lowering income tax and Medicare or IRMAA premiums. C, it's only available to those who have already reached full retirement age. Or D, it can only be used for donations to private foundations. Answers are coming in. People are changing answers. Right. Good job. So it's A and B are tricky, but technically A is wrong because it doesn't matter whether you itemize or not. The QCD is still going to result in a reduction in your adjusted gross income. So it's close, but the more accurate answer is B. It reduces your adjusted gross income, lowering income tax, and because the QCD is considered kind of an above-the-line deduction, your AGI or your modified AGI is really what's used to determine kind of IRMA, those IRMA surcharges that I'm sure we've all seen and hate. Well, I haven't seen it yet, but one day I'm sure it'll be very bad. But a lot of you know about it. We hear other stories. It's terrible. This helps to reduce that threshold which the IRMA is based on. That's why doing the QCD is so much more effective than getting the money and then contributing it to the charity. Because then it would be a below the line deduction. And again, that only matters if you're itemizing. Important point here, you cannot do, because the first thing people are, oh, can I do a QCD to my donor advised fund? You cannot. So with the QC, it has to go directly to an end charity. Okay, so let's just look at kind of another example here. So you have a client, person who's age 75, they have a requirement of distribution that they have to take of 20,000, and they also want to give 10,000 to charity. In a traditional withdrawal, right, their taxable income will be $10,000 higher, right? Their RMD does get satisfied, but they pay their tax bill plus 2,400. Whereas with the QCD, right, the first 10,000 goes to the charity, so only $10,000 is actually coming into your income as taxable. It still satisfies your RMD, and you have a tax savings of $2,400. So let's compare the two, right? A DAF who's eligible, anybody, right? Or any adult, and the QCD, IRA owner, and you have to be 70.5. Tax benefit timing, it's an immediate deduction, also an immediate deduction, but here direct exclusion means the income is not even counting as part of your adjusted gross income, right? Because of the QCD. Funding source with the DAF, right? It's security. So from your brokerage account, could be cash, but it's not a non-retirement account. And here it's only can be from a traditional IRA, right? The DAF is best for planning flexibility, large kind of itemized deductions you're looking for, doing a large lump sum and then spacing out your grants over time. And this is specifically to reduce income from RMDs, reduce taxes from RMDs on money you don't otherwise need. So what is the maximum age at which you can make a qualified charitable distribution? This is a tricky one. What is the maximum age? We know the minimum age. We talked about that, right? The maximum age is as long as RMDs are coming out. Now, I'll give you another curveball. Can you do a QCD from an inherited IRA? Nobody can answer me, but it's rhetorical. And the answer is, I thought the answer was actually no to that. And the answer, I believe, is yes. My team can fact check that. But just because a lot of you I know now have these inherited accounts from parents, sadly, who passed, and may not be aware that you can do that to QCD. But again, I'm pretty sure that 70.5 still has to be met. So here, right, there is no maximum age, right? This is why this is a discerning question. If you're 80 and still have RMDs, you can do it. 90 RMDs, you can do it. So you're charitably inclined, as long as you're taking RMDs, you can do QCDs. So again, just another comparison, right? You're set for QCD, you're 70.5 or older and want to give directly to a charity, and you have to satisfy RMDs anyway, and you don't want to increase your taxable income unnecessarily. And then for a DAF, you want flexibility to distribute the grants, and you want to donate appreciated assets, avoid capital gains, have like a large tax deduction in a high income year. That's when the DAF is great. And you can do both, right, depending on the circumstances. Oh no, I already gave you this answer. Can a QCD be made directly to a DAF? Yes, always. B, no, never. C, yes, but only if DAF is set up for a public charity. Or D, no, only direct transfers to a public charity are allowed. What do you guys think? Looks like a lot of people are saying B, and that is correct. That is correct. So common mistakes to avoid. So this is, I think the big one here is the second bullet, right? If you do a QCD, a lot of people think, oh, I gave to a charity, and they'll do the QCD, but then they'll also include it as an itemized deduction. And you can't do that. By doing it as a QCD and labeling it, it's already reducing your income. You can't then double reduce it again. So I think a lot of people just make that mistake. And then it needs to be made. These decisions with DAFs and QCDs really do need to be made in the context of your overall tax and estate plan and financial plan. Right. And that's what I was kind of saying was like, if you look at what your new itemized deduction amount will be with the new SALT cap, with what you're thinking of doing a charity, and then compare it to your standard deduction and just see from a strategic standpoint what makes the most sense. Because again, in years where your itemized deductions are really low, your mortgage is paid off, you just don't have as, you still get that standard deduction, right? So you get the higher of the two. So even if in 1 year you got $100,000 of deductions because you did a giant QCD, and then every other year it was like you're just getting the standard deduction, that's still great. And ideally, that big deduction year also coincided with a higher income year. So I just want to make that point. And again, this is very rare, the donating of illiquid assets, but to the extent you are doing it, it's got to be appraised. You have to have a proper valuation. Okay, now we're going to switch gears a little bit, where we're not talking about giving to charity. We're talking here more about giving to individuals, loved ones, family, okay, people like that. Now, here's the current rule is the federal estate and gift tax exemption amount, okay? They're combined as one kind of unit. And it's the amount that you can transfer tax-free, okay, avoiding what's called gift or estate tax during your life or at death. Anything above these amounts, right, would be taxed at 40 cents on the dollar. This used to be a temporary thing. It was made permanent starting in 2026. So there is no sunset cliff. Legislation would have to be passed to bring this down. It's very material. So for an individual in 2025, the gift and estate tax exemption amount is 13.99 million. So in total, between the two, it's almost 28 million. And then in 26, they go to 15 million per person or 30 million per couple. Okay, and then it will index for inflation from there on out. Could that drop down again? New administration, sure, it could. But we haven't seen it go down yet, even going all the way back to Obama. So it seems like, if it went down, I don't, my gut is it wouldn't go down materially back to like the 1 or 3.5 million it used to be in the early 2000s. So what does this mean? What this means is if you decide that you want to give a large portion of your estate away while you're living, you can do that. And as long as it's under this amount per person or this amount total starting next year for a couple, then you could give it away. You'll file a gift tax return 709 to say, hey, I've used this amount of my exemption. But as long as it's under that amount, you're not going to pay gift taxes. If the donor is always the one who will pay the gift taxes. If you give the money to a kid, the kid's never responsible for the gift taxes. That's on you. Okay. So just as a starting point, like that's the base rule. But then what they allow for in addition to that, because, people want to take their kids on trips, or they want to, give money for a down payment on a house. That's a huge one that we see with clients. And they're like, boy, I don't want to have to file a gift tax return, and the IRS doesn't probably want to deal with that. So then they created this thing called the annual gift amount exclusion. All this says is this is the amount of money any person can give to another person, and nothing needs to be reported as long as it's that amount or less. So for 2025, that amount is $19,000 per person per recipient, right? So this is a great strategy to reduce your taxable estate over time and not have to file the gift tax return. And you can do what's called gift splitting with your spouse to double the amount. So As a case in point, if my wife and I wanted to give the maximum gift tax exclusion amount or annual gift exclusion amount to our kids each year, we could give $38,000, right, to each of our children. Never, don't have to file anything, no taxes paid. Because it was the annual gift exclusion amount. You can give that really to anyone you want. You want to give it to nephews, nieces, cousins, brothers. As long as it's 19,000 per person, meaning per donor, per recipient or less, each calendar year, you're good. Okay. Now, many of you are aware that to save for college, a very effective way to do that is through a 529 college savings plan. Well, some people say, well, I want to do more than the amount that you're talking about because I want the money to start working, or hey, they're already in high school, like this needs to get going. So you can actually do what's a front-loaded 529 lump sum contribution, and you have to elect that you're doing the 5-year gift tax exclusion, but this is just the 19,000 times 5 or 95,000 per child. Now, if you take husband and wife, right, you can double that. Now it's 190,000 for one kid you can do. What that means is just that you have now used your annual gift exclusion for that child for the next 5 years. So why would people do that? Well, one, it allows a lot more money to start working for them in that 529 plan immediately. And to the extent that money is needed for college, like sooner than 5 years, it allows them to access it. And if not all of the money's, if not all the money's used up, if the person who makes this gift also is the owner, okay, the donor is the owner of the 529 with the child as the beneficiary. If that child doesn't need all of it, they can move it to another grandchild. Okay, there's a lot of flexibility in changing where this money ultimately goes. So hopefully that helps give you some clarity around. Well, I know there's this gift and estate tax exclusion amount, but then there's also this annual exclusion amount, and how do they interact? So this is the annual exclusion amount. Nothing has to be filed. If you go above these amounts in any year, that's what starts to eat into your lifetime exemption amount, which was that $15 million basically, or 13.9 for this year. In addition to the annual exclusion of the 19,000 per year or 38,000 if you're doing it with your spouse, right? You are able. A lot of people don't realize this, but if you just pay directly to the provider for medical expense or tuition, that doesn't even factor in to the gift tax or anything. That doesn't factor in the annual exclusion. That doesn't factor into the lifetime exemption. So let's say one of your children or grandchildren has a really large medical bill that's straining them. You can pay the medical provider directly and you're good. They go to college, they go to a private school, you want to help out. You can pay that school directly for that tuition. And again, doesn't impact any of the other gifts you're doing. Right? Now, you have to be careful. Let's say your child has a dog and the dog gets really sick, and some of these vet bills can be very material. The medical provider has to be to a human. It can't be to a non-human, unfortunately. So that's one caveat. But you can see here long-term care, hospital bills, health insurance payments, a lot of flexibility around this. Another thing to keep in mind is if you gift, a lot of people don't want to gift cash to their kids. They want to give securities that are highly appreciated that they don't really want to sell and they don't want to pay the tax on. If you give that appreciated security to your child, they will inherit your cost basis. And that's not necessarily a bad thing. It's just something to be aware of, that if you have a security that's worth $50,000 and you paid $5,000 for it, there's $45,000 of embedded gains, and you give all of that to, one or more children, if they were to sell that it would be like their basis was 5,000, and so they would have the gain of that 45,000. Okay, and that's fine. Like if that's what you're comfortable doing, that's fine. It just means that if your kids are already in a pretty decent tax bracket, it's not helping them from a tax standpoint, because they're going to incur probably the highest capital gains rates on that security. But there's still money they didn't have before. So we talked a little bit about 529 plans, right? 5-year gift averaging. That's if you want to do a really large contribution. Once that's done, there's no additional annual exclusion amounts you can do during that 5-year period unless you go into the lifetime exemption. And if the donor of that 529 plan dies within 5 years, the unused portion is added back to their estate. So in general, once you gift money away, it's out of your estate. It's not subject to estate tax. Well, in this scenario, if you die 2 years after, let's say you got a diagnosis and we're trying to get things out of your estate, that's typically what people try to do. There's a look back here. If you don't live for that 5 years, they're going to claw back that in terms of what's considered in your estate if you do that 5-year election. So quick kind of, we call it super funding to 529. Grandpa Joe gives a lump sum of $95,000 to Ben's 529 plan. The IRS is going to treat this as $19,000 per year over 5 years. Doesn't eat into the lifetime exemption amount, right? And the benefit is the $95K immediately starts to grow tax deferred, all of it, rather than doing it in increments over 5 years. So just more money working faster. So a couple things we kind of talked about this, but the freeze rule, right? Because the $95,000 for that child uses the annual exclusion for all 5 years, you can't give any other gifts to that beneficiary until the period is over. The caveat is if the annual exclusion amount goes from 19 to 20, then you could do the additional 1,000 the following year, right? And then the survival rule is if you don't live through the full 5-year period, they'll kind of look back and pull the money back in for the years that you didn't survive, in terms of just looking at, hey, are they going to be over the estate tax exemption amount? It may not be relevant, right? But they're at least going to include it in your estate. Whereas money you give to a DAF, that's immediately out of your estate, even if it all hasn't gone to the end charities. So again, from an estate planning standpoint, it reduces the size of your estate. Okay. So again, the disclosure is this is for informational purposes only. We're not CPAs, we're not attorneys. You need to consult directly with those professionals. We're happy to be a part of it. And this is just general informational purposes only. So I did see a question here. So the question is, can a contribution to a DAF be made from a traditional IRA? Yes, the answer is no, unfortunately. It's a great question. Are there any other questions that people have? If there are, you just put them into the Q&A box and we will get them. And again, what we will do is we are recording this, so we'll upload it and send you kind of the link to the YouTube of this video, so that you can kind of share it if you want, or listen to it at your own leisure. And we'll also do our best to provide a summary email to those who attended to just say, hey, here's the big points of what we talked about, so that you can kind of digest it that way as well. So I'm going to give just a few more minutes here for people to put their questions in, and then we'll let you get on your way with lunch. I don't know whether no questions means it was so thorough that it answered everything, or that it was so non-understandable that people don't know where to start. So either way is fine. I think after we provide the summary email, and I think a lot of you know a lot of this if you've been meeting with us, just because it's things that we do bring up in our reviews and part of our. Okay, here's another question. Yes. So the question is, if you donate appreciated stock into a donor advised fund, can you immediately sell for cash? Yes. So once the donor advised fund can't hold individual stock. So once it goes in there, they're going to liquidate it. No taxes are incurred, and it will be that cash will then be there to grant to charities or to reinvest or both. Great question. Any other questions? All right, they're coming in. Okay. It seems that married couples have greater benefits even if the income levels are the same. What can be done? Yeah, it's true. There's definitely, even if the income level is the same, the deduction that a married couple gets is higher than a single filer. I think it just highlights the importance of being as disciplined as possible with your tax planning strategy, right? There's nothing, we can't change the rules around how big the standard deduction is, but what we can do is look at your situation in that year and say, okay, what is the income? What is going to be your other itemized deductions? How much are you generally giving to charity? And then what is an amount to give to the DAF that would be materially reduce your taxes for that year? But even as a single filer, remember, there is still that senior, you're eligible potentially for that senior bonus, that additional $6,000 on the standard deduction side. So again, we can't change the tax code, but I think that what can be done is just you need to be even more vigilant to the opportunities that are available. Okay, more questions are coming in now. What are options to use 529 plans for gifting that have no further use for educational purposes? That is a very good question. So if you have excess money sitting in a 529 and there is no one to transfer it to for any sort of school purpose, and that doesn't have to be undergraduate or graduate, that could be a vocational school, technical school. I mean, it's fairly flexible, but beyond that, it's exhausted and there's no beneficiary, no other grandchild or cousin or sibling you can give it to. Then it's basically like if you say, all right, I just want to take this out, anything you put in will not be taxed again, but any gains in the 529, that would be subject to ordinary income tax and a 10% penalty. So there is though an option if there's money left over, you can do $35,000 as a lifetime amount that can ultimately convert to a Roth for that child. So that is something that's not insignificant. And we can talk more offline about that. Last question: after you sell appreciated stock, can you reinvest in another stock and allow it to appreciate tax-free? Yes, you can reinvest it and allow it to appreciate tax-free, but you can't buy another individual stock. In a donor advised fund, you're going to have kind of like a 401k. You're going to have pre-selected options that you can choose from, like a stock market index fund, a domestic active fund, an international fund, bond funds. You'll have 10 or 20 different options. So I think you can still replicate what stocks will do over the long term, but you can't say, I'm going to sell Apple, I'm going to buy Lockheed Martin. Like that, you can't do. It can sell the Apple and then it can be reinvested into one of the pre-selected investment options. For those of you who did ask questions, can you give me some feedback as to whether I addressed in part your questions? You can do a thumbs up maybe, or there's usually some different icons at the bottom that allow you to even a hand raise would let me know. Okay, or you can do it in the Q&A. Okay, yes, thank you. Any other questions? These are really good questions. So if you have more, I'm here, and you can always send them in after the fact. But I don't see any additional questions coming in, so we can go ahead and leave it there. Thank you all. I really appreciate you making the time. We try to make these as interesting and educational as possible and not bore you. I realize this stuff can be very technical, and boring because of that. So doing my best. We're going to try to make it more interactive even than we are today in the future. Got to be creative to do that, but that's the goal. So thank you again for attending. I don't see any additional questions, so I'll let you all go. And you can always email us if you have any follow-up questions. Take care. Bye-bye.